Stop what you're doing. Close the other tabs. This one requires your full attention. There is a number you need to hold in your mind for the next 20 minutes. $4.2 trillion. That's the estimated size of Japan's yen carry trade. It's not a government debt figure. It's not a GDP number. It's the amount of money that has been borrowed in yen at near zero interest rates and deployed into higher yielding assets around the world. And for 30 years, this trade has only moved in one direction. Until now. In the next several months, you hope, are going to watch financial media explain what is happening in global markets using language like volatility event and risk-off sentiment and a flight to safety. Those phrases will be accurate in the way that describing a building collapse as structural settling is accurate. They will tell you what happened without telling you why it had to happen. This video is about the why, and the why begins in a place most people aren't watching. Here's the quiet signal. In the last year, Japanese government bond yields have moved in a way that hasn't happened since 1990. The 10-year JGB yield crossed 1% for the first time in over a decade. That number sounds small. It sounds irrelevant. 1%. In a world where US Treasuries yield 4.5% and corporate bonds pay 6%, why would anyone care about 1%? Hold that question. Because that 1% is not a return. It's a cost. And it's a cost that underpins the largest leveraged position in global financial history. When the cost of something that was essentially free for 3 decades suddenly isn't free anymore, you don't get a gradual adjustment. You get a repricing of everything that was built on the assumption it would stay free forever. By the end of this breakdown, you will understand exactly how the yen carry trade works mechanically, why its unwinding is now structurally inevitable, and what sequence of events you should expect to see in global equity markets, bond markets, and currency markets as this unfolds through 2026. This is not speculation. This is the math. And the math has an expiration date. Let me establish something important. The carry trade is not complicated. It's actually one of the simplest trades in finance. You borrow money in a currency with low interest rates. You convert that money into a currency with higher interest rates. You invest the proceeds in assets that yield more than your borrowing cost. You pocket the difference. That's it. That's the entire trade. Think of it like this. Imagine you could get a mortgage at 0% interest, not low interest. 0. And imagine you could take the money you borrowed and put it into an account paying 5%. You would borrow as much as the bank would give you. You would do this forever. You would tell your friends. Your friends would do it. Their friends would do it. Eventually, everyone who could access this trade would be in it. That's what happened with yen. For 30 years, the Bank of Japan kept interest rates at or below 0%. For most of that time, US rates were between 2 and 5%. Australian rates were higher. Emerging market rates were higher still. The trade worked. It worked so well that it became the foundation of global leveraged positioning. Here's where the technical layer matters. The carry trade doesn't just involve investors borrowing yen. It involves banks, pension funds, insurance companies, sovereign wealth funds, and hedge funds, all borrowing yen to fund positions in other currencies and other assets. When you add up all of these positions across all of these institutions, you get that $4.2 trillion figure. That's the gross exposure. The net exposure is smaller, but the gross number is what matters for market mechanics. Because when a trade unwinds, it unwinds gross. Stay with me here. This is where the structure becomes important. The official story you will hear about Japan in 2026 goes something like this. The Bank of Japan is normalizing policy. They're raising rates slowly. They're managing the transition carefully. Markets are adjusting in an orderly fashion. This is a sign of economic strength, not weakness. Japan is finally exiting deflation. The yen is finding a fair value. Everything is under control. That story is not false. It's just incomplete. Here's what the official story leaves out. The Bank of Japan doesn't control the exit. They control the entrance. They can set the policy rate. They can adjust yield curve control bands. They can communicate intentions. What they cannot control is how $4.2 trillion of leveraged positions respond to a change in the fundamental economics of the trade. Let me walk you through the system layer by layer. Layer 1, the funding leg. Every carry trade has a funding leg and an investment leg. The funding leg is where you borrow. For yen carry, this means borrowing yen directly from Japanese banks, or borrowing yen synthetically through forward contracts, or borrowing yen through the repo market. Each of these mechanisms has different costs, different durations, and different rollover requirements. Some positions roll daily, some roll monthly, some roll quarterly. This matters because a change in the funding cost doesn't hit all positions at once. It hits them on their rollover dates. So a rate increase in January might not fully impact the trade until April or July, depending on the structure of the position. Layer 2, the currency leg. Once you've borrowed yen, you need to convert it to another currency to invest. This conversion creates a currency exposure. If the yen weakens, you profit on the currency in addition to the yield differential. If the yen strengthens, you lose on the currency, which can wipe out the yield gain. For 30 years, yen weakness has been the default assumption. The yen went from 80 to the dollar to 160 to the dollar. Carry traders made money on both legs, the yield and the currency move. Layer 3, the investment leg. The borrowed and converted funds get deployed into assets, US Treasuries, US corporate bonds, Australian government bonds, emerging market debt, US equities, tech stocks, private credit, real estate. The carry trade doesn't have one investment destination. It has thousands. And each of those destinations has its own liquidity profile, its own volatility characteristics, and its own sensitivity to rising Japanese rates. Layer 4, the hedging leg. Some carry trades are hedged, some are not. Hedged carry trades use forward contracts to lock in exchange rates, but the hedging cost eats into the yield differential. Unhedged carry trades keep the full yield, but take the currency risk. As the yen started weakening aggressively in 2022 and 2023, more traders went unhedged. Why pay for insurance when the underlying trend keeps working in your favor? That decision to drop hedges is now a source of concentrated risk. Layer 5, the leverage layer. Carry trades work best with leverage. A 2% yield differential on unleveraged capital is boring. A 2% yield differential on 10 times leveraged capital is a 20% return. Most institutional carry trades use leverage ratios between 5 and 15 times. Some use more. This means that a relatively small move in the underlying economics can create enormous mark-to-market losses. Here's the critical point. Each of these 5 layers is now experiencing stress simultaneously for the first time in decades. The funding cost is rising. Japanese rates are moving higher. The 10-year GB yield above 1% represents a 300% increase from the 0.3% levels of 2022. That sounds extreme because it is extreme. The currency leg is reversing. After hitting 160 to the dollar in 2024, the yen has begun to strengthen. Each strengthening move creates losses for unhedged carry traders. The investment leg is under pressure. U.S. equities are at high valuations with elevated rate sensitivity. Bond prices have already fallen significantly since 2021. Emerging market assets face dollar strength headwinds. The hedging costs have spiked. Forward points on yen hedges have moved from negligible to material, eating into the already shrinking yield differential. And leverage multiples that worked in a calm environment become death spirals in a volatile one. This is where the assumption breaks. The entire carry trade is built on one assumption: interest rate differential stability. Traders don't need Japanese rates to stay at zero. They just need the differential between Japanese rates and the rates they invest at to stay wide enough to cover the risks. When you borrow at 0 and invest at 5, you have 5% of cushion. When you borrow at 1 and invest at 4.5, you have 3.5% of cushion. That's still positive, but margin for error has collapsed by 30%. Now, layer in currency volatility. The yen has moved from 160 to 140 to the dollar and back in a matter of months. A 20 yen move on a carry trade represents currency losses that can easily exceed the annual yield pickup. For leveraged positions, a 10 yen move against you can wipe out 3 years of carry income in a week. The assumption that broke is not that rates would stay at 0 forever. Everyone knew that was temporary. The assumption that broke is that the exit would be slow enough to allow orderly repositioning. That assumption no longer clears. Let me walk you through the internal calculation. This is how risk desks are looking at this trade right now. Start with a baseline. A hedge fund has a yen carry position sized at $500 million notional. They borrowed yen at 0.2%. They invested in US corporate bonds yielding 5.5%. They used 10 times leverage on their equity. Their carry income is roughly $53 million per year. Their equity at risk is $50 million. The trade makes sense. It's printing money. Now add the new conditions. Japanese rates rise to 1%. Their funding cost goes from $1 million per year to $5 million per year. That's a $4 million hit to their carry income. Still positive, but tighter. Now add currency volatility. The yen strengthens from 155 to 140. That's a 10% currency loss on the funding leg. On a $500 million notional, that's a $50 million loss against $50 million of equity. Now add mark-to-market on the investment leg. U.S. corporate bond prices fall 3% on rising Treasury yields. That's another $15 million loss. Total loss, $65 million. On $50 million of equity, the position is underwater by 30% more than the entire equity base. The prime broker calls. Margin must be posted by tomorrow. If it isn't posted, the position is liquidated. This is where the math stops working. The hedge fund has 3 choices. Post more margin, sell assets to raise cash, or get liquidated by their prime broker. If they post more margin, they're doubling down on a losing trade in a worsening environment. If they sell assets, they're selling into a market where other carry traders are also selling. If they get liquidated, the prime broker sells for them at whatever price clears the market. Now multiply this scenario by several thousand firms. different sizes, different leverage ratios, different rollover dates, different investment portfolios, but all facing the same fundamental problem. The carry trade economics that justified their positions no longer exist. This is where feedback loops begin. When carry traders sell, they sell assets to raise currency. They sell US bonds, US stocks, Australian bonds, emerging market debt. This selling pressure pushes those asset prices down. Lower asset prices create more mark-to-market losses for other carry traders. Those losses trigger more margin calls. More margin calls trigger more selling. More selling pushes prices down further. Simultaneously, carry traders have to buy yen to repay their funding. They convert dollars, euros, and Australian dollars back into yen. This yen buying pushes the yen stronger. A stronger yen creates more losses for unhedged carry traders. More losses trigger more unwinds. More unwinds mean more yen buying. The yen gets stronger still. Think of it like a crowded theater with one exit. If one person walks to the exit calmly, nothing happens. If 10 people walk to the exit, nothing happens. If 100 people suddenly realize there's only one exit and they all need to get out, the exit becomes a bottleneck. The bottleneck creates panic. The panic creates a stampede. The stampede hurts people, regardless of whether there was ever actually a fire. This is the liquidity dimension. In normal markets, there are always buyers for what you're selling. Maybe not at your preferred price, but at some price. In stress markets, buyers disappear. Market makers widen their spreads. Trading desks reduce their balance sheet exposure. Liquidity that looked abundant when everyone was calm evaporates precisely when it's most needed. We saw this briefly in August 2024. The yen carry trade partially unwound over 3 days. The Nikkei dropped 12% in a single session. US markets fell 4%. The VIX spiked to 65. And then central banks signaled accommodation. The yen weakened again, and the carry trade reestablished. The August 2024 event was a tremor. It showed what the earthquake will look like. The structural conditions that caused the tremor have not improved. They have worsened. Let me describe the split reality we are now entering. On one side, you have prices, asset prices in major markets, equity indices, bond yields, currency pairs. These prices reflect the current trading activity of participants who are still in the carry trade, still leveraged, still positioned as if the old assumptions hold. On the other side, you have availability, the actual amount of capital willing to step in and buy at those prices if selling accelerates, the depth of order books, the capacity of dealers to absorb inventory, the willingness of long-term investors to catch falling knives. Price says assets are worth a certain amount. Availability says there's no one to buy them at that amount if forced selling begins. These two realities can coexist temporarily. They cannot coexist permanently. Convergence happens when forced selling meets shallow liquidity. Convergence is not gradual. Convergence is a gap. Here are 3 outcomes for how this resolves. I'm assigning rough probabilities based on mechanical assessment, not prediction. Outcome 1. The Bank of Japan reverses course and cuts rates back to 0 or negative while reinstating aggressive yield curve control. This would be the Hail Mary attempt to reestablish carry trade economics and prevent the unwind. The problem is it requires abandoning all credibility on inflation normalization precisely when Japanese inflation is finally at target. It requires accepting unlimited yen weakness, which creates import cost inflation that makes domestic inflation worse, and it requires coordinating with a Federal Reserve that may not be cutting rates fast enough to help. This outcome has perhaps a 10% probability. It's theoretically possible, but institutionally almost impossible. Outcome 2, disorderly unwind. The carry trade unwinds in a cascade over days or weeks. Forced liquidations overwhelm dealer capacity. Asset prices gap lower across global markets. The yen spikes 20 or 30% in a short period. Margin calls cascade across the financial system. Central banks intervene after the fact, but cannot prevent the damage. Institutions with concentrated carry exposure become insolvent. This outcome has perhaps a 30% probability. The mechanics are in place for it. Only the timing and trigger are uncertain. Outcome 3. Managed unwind with episodic volatility. This is the current trajectory. The Bank of Japan continues raising rates slowly. The yen strengthens gradually. Carry traders unwind their positions over quarters rather than days. Each episode of acute stress is met with central bank communication, intervention, or policy adjustment that prevents cascade. The cost is absorbed over time rather than all at once. Global markets experience higher baseline volatility but avoid systemic crisis. This outcome has perhaps a 60% probability. It's the path of least resistance for policymakers. It's also the path that requires everything to go right for 18 months straight. Notice what's missing from these outcomes. A scenario where the carry trade doesn't unwind. That's not an outcome. That's arithmetic. When your borrowing cost rises and your investment return falls and your currency move turns against you, the trade unwinds. The only question is how. Here's what this means if you're watching markets. This is not financial advice. I don't know your situation, your risk tolerance, or your time horizon. What I can tell you is how to frame what you're seeing. When you see volatility spike in global markets and the explanation is something vague like risk-off sentiment or growth concerns, look at the yen. If the yen is strengthening sharply, you're watching carry trade unwind mechanics, not economic fundamentals. The two are related, but not identical. When you see coordinated selling across asset classes that don't normally correlate, U.S. equities selling with U.S. bonds, selling with emerging market assets selling, you're watching forced liquidation, not fundamental repricing. Forced liquidation doesn't discriminate between good assets and bad assets. It sells what can be sold. When you hear that Japan's market had an extreme move overnight and it does not affect us, be skeptical. $4.2 trillion of leveraged positioning affects everyone. The yen carry trade is not Japanese. It's global. The funding is Japanese. The investments are everywhere. Here are the indicators to watch, not with anxiety, with calm attention. First, the dollar-yen exchange rate. Moves below 140 indicate stress. Moves below 130 indicate acute stress. Moves below 120 indicate potential cascade conditions. Second, Japanese government bond yields. The 10-year above 1.2% suggests the Bank of Japan is losing control of the curve. Above 1.5% suggests serious dysfunction. Third, the VIX. Sustained levels above 25 indicate elevated hedging demand. Spikes above 40 indicate potential systemic stress. Fourth, cross-currency basis swaps. This is more technical, but it measures the cost of converting dollars to yen in forward markets. When this cost spikes, it means institutions are scrambling for yen funding. That's a real-time indicator of carry unwind pressure. Fifth, central bank communication. Watch for emergency meetings, unscheduled statements, or intervention announcements. These are reactive indicators that stress has reached levels requiring official response. Let me zoom out. What you're watching with the yen carry trade is not just a Japanese story or a currency story. It's the end of an era in global monetary policy. For 3 decades, Japan provided the world with essentially free capital. That capital flowed into every asset class and every market. It suppressed volatility. It compressed risk premiums. It made leveraged strategies appear safer than they were. It inflated asset prices beyond what domestic savings alone would support. That era is ending. Not because Japan chose to end it, because arithmetic forced the choice. Japanese inflation reached levels that required policy response. An aging population requires returns on savings. A weaker yen raised import costs beyond tolerance. The Bank of Japan is not normalizing by choice. It's normalizing because the alternative became impossible. When that free capital is withdrawn, everything it supported gets repriced. The repricing doesn't happen in a straight line. It happens in fits and starts, with periods of calm followed by bursts of violence. August 2024 was a burst. There will be more. The question is not whether the carry trade unwinds. It is unwinding. It has been unwinding since 2023. The question is whether the remaining unwind happens over years with manageable volatility or over months with systemic consequences. Policymakers are trying to engineer the first outcome. Markets may deliver the second. 2026 is when the structural factors converge. Cumulative Bank of Japan rate increases reach a threshold that makes the math definitively negative for most carry positions. Yen strength from unwinding creates acceleration rather than stabilization. Federal Reserve policy may not provide the offsetting ease that absorbed previous episodes. The positions that survived 2024 hit their stop-loss levels. This is not prediction. This is positioning meeting mechanics. The largest leveraged trade in financial history is facing the conditions that unwind leveraged trades. The traders know it. The institutions know it. The central banks know it. What remains is execution. Watch the signals. Understand the mechanics. Prepare for volatility that serves no fundamental purpose except to reestablish a balance that leverage distorted for 30 years. The question is not if the carry trade unwinds. The question is not even when. The question is how long you have before the next episode and whether that episode is the one that cascades. The math says not long.